Right now, the market is flashing a price that validates years of patience for the believers and signals a nightmare scenario for the skeptics. SoFi Technologies, Inc., ticker symbol SOFI, is currently trading at 29.05 USD, posting a robust intraday gain of plus 0.72, 2.54% as of this very moment on Wednesday afternoon. The tape is moving with aggressive velocity, and we are seeing a volume profile that suggests this isn't just retail traders chasing a green candle, this is heavy institutional accumulation. We are knocking on the door of the psychological $30 level, a fortress of resistance that, if breached, changes the entire technical complexion of this stock from a recovery play to a blue sky breakout. The price action we are witnessing right now at $29.05 is the market finally admitting that it mispriced this company for the better part of 3 years. The expectation for SoFi has always been somewhat dismissive. If you ask a typical Wall Street analyst or a casual observer on a Robinhood stock trading forum, they will likely tell you that SoFi is just a student loan company or a glorified checking account that got lucky during the SPAC boom. The expectation is that it is a cyclical business, heavily dependent on interest rates and government policy regarding student debt. They view it as a niche player, a neobank, that will eventually be crushed by the sheer scale of J.P. Morgan or Bank of America. That is the expectation, a fragile fintech, heavily exposed to credit risk. But the reality, and this is the insight that is driving the stock up 2.54% today, is that SoFi has successfully executed the Amazon of finance strategy. They have built the AWS of banking through their Galileo and Technisys platforms. The reality is that SoFi is no longer just a consumer-facing bank, it is the infrastructure backbone for a massive chunk of the fintech industry. While the market expects a lender, the reality is a technology platform with banking licenses. And technology platforms trade at much higher multiples than banks. This disconnect between bank valuation and tech valuation is what is being reconciled right now on the chart. To understand why $29.05 is such a critical level, we have to look at the friction in the broader financial sector. Traditional banks are struggling with legacy IT systems, code written in the 1980s that makes innovation impossible. They are bleeding customers to agile competitors. SoFi doesn't have this problem. They own their tech stack from top to bottom. This vertical integration is a term often thrown around, but in banking, it is the holy grail. It means SoFi has the lowest cost of funding in the industry because they hold their own deposits and they have the fastest speed of product iteration because they own the core banking ledger. When you see the stock pushing toward $30, you are seeing the market reward superior unit economics. It's the same realization investors had when they realized Tesla stock wasn't just about cars, but about manufacturing efficiency. SoFi is manufacturing financial products cheaper and faster than anyone else. Let's talk about the institutional flow, because that is what sustains a move like this. For a long time, the big mutual funds and Fidelity wealth management accounts stayed away. They saw SoFi as too risky, too volatile. But look at the 13F filings over the last 2 quarters. The ownership base has shifted. We are seeing pension funds and sovereign wealth funds entering the name. Why? Because the profitability question has been answered. SoFi is not just GAAP profitable, they are growing earnings per share at a rate that justifies a growth multiple. When a manager at Fidelity Investments sees a company growing revenue at 20% plus while expanding margins, they have a fiduciary duty to pay attention. The volume we are seeing today, millions of shares changing hands above $29, is likely the result of these large funds building positions, not day traders flipping for pennies. However, we need to address the immediate market dynamics. The stock is up 2.54% today, outperforming the broader fintech sector. This relative strength is crucial. It tells us that capital is rotating out of stagnant assets and into SoFi. Traders using interactive brokers trading platforms are likely looking at the relative strength line versus the XLF, the Financial Select Sector SPDR fund, and seeing a massive divergence. SoFi is leading, and in the stock market, you always want to be with the leaders. The chart shows a classic cup and handle formation on the weekly time frame, and we are currently in the handle portion, coiling for a breakout. The tension here is palpable. If the bulls can push this over $30, it triggers a cascade of automated buy orders from the algorithmic trading desks, which could send the stock vertically toward $35 in a matter of days. Let's pause and discuss the ecosystem, because this is the moat. Most people know SoFi for student loan refinancing, but if you use the SoFi Invest platform, you know it is much more. They have successfully cross-sold their user base. A user joins to refinance a loan, then opens a checking account, SoFi Money, then starts self-investing via the app, and maybe eventually takes out a mortgage. This financial super app strategy reduces the customer acquisition cost to near zero for the second and third products. A traditional bank like Wells Fargo has to pay hundreds of dollars in marketing to sell you a credit card. SoFi just sends a notification to the app you are already checking 5 times a day. This efficiency is the secret sauce that isn't fully appreciated by the skeptics. It's why their margins are expanding while others are contracting. I want to know where you stand on this ecosystem. Comment below how many shares of SoFi you currently hold, and specifically, let me know if you are actually a user of their products. There is often a strong correlation between people who use the SoFi mobile app and those who hold the stock long term. Now let's analyze the business segments deeply. The lending segment has always been the cash cow. Despite the volatility in interest rates over the last few years, SoFi's personal loan business has remained incredibly resilient. They target high-income earners, people with high FICO scores who pay their bills. This is a very different demographic than the subprime borrowers that credit card companies often worry about. SoFi's borrowers have high free cash flow. This credit quality has allowed SoFi to maintain low default rates even when the economy gets shaky. If you are comparing this to Robinhood stock trading, remember that Robinhood is transactional. They need you to trade to make money. SoFi makes money when you sleep, through interest income. It is a more recurring, predictable revenue stream, which is why Schwab Intelligent Portfolios might start weighing it more heavily as a core holding rather than a speculative one. But the real jewel, the part of the business that justifies the $29 price tag and beyond, is the technology platform segment, Galileo and Technisys. Think of Galileo as the plumbing for other fintechs. When you use a debit card from a neobank or a B2B payments platform, there is a high chance Galileo is processing that transaction in the background. They take a tiny fee every time money moves. This is volume-based revenue. As digital payments grow globally, Galileo grows. It is an index on the digitization of money. And Technisys allows them to offer the core banking layer to legacy banks. There are thousands of small and mid-sized banks in the U.S. that are desperate to modernize. They can't build it themselves, they will buy it from SoFi. This B2B revenue is sticky. Once a bank installs SoFi's tech, they are not leaving. It creates a recurring revenue stream that commands a high valuation multiple, similar to a SaaS, software as a service company. We also have to look at the macro environment. We are currently in a phase where the yield curve is normalizing. For a bank, this is nirvana. They borrow short and lend long. As the spread between short-term rates and long-term rates widens, SoFi's net interest margin, or NIM, expands. This is pure profit falling to the bottom line. Additionally, the capital markets are opening up. SoFi has a robust capital markets division that helps companies IPO or raise debt. As the IPO market thaws, this creates another revenue stream that has been dormant for a while. It's like firing on all cylinders: lending, technology platform, and financial services. Let's tackle the risks, because a professional analysis must be balanced. The stock is at $29.05, which is not cheap by traditional book value metrics. You are paying a premium for growth. If that growth slows, if they miss a quarter of user ads, or if the loan delinquency rates tick up unexpectedly, the stock will be punished. We have seen it before. The volatility in SoFi stocks can be stomach-churning. A 20% drop in a week is not unheard of. Furthermore, regulatory risk is always present. The government loves to scrutinize banks, especially fast-growing ones that disrupt the status quo. Increased capital requirements could